There, so I think we're ready to get started. Welcome to our Chamber's Bring Your Own Lunch webinar. So we are hoping to be able to do these on a weekly basis, bringing information to our members and businesses in the community that have questions, need information, and would like some answers. So today's webinar, our guests are with Grant Thornton, and they'll be talking about managing financial matters and guiding businesses through COVID-19. We know there's a number of questions out there, and people are wondering, how to navigate some of the government programs, how to find other resources that will help them through this. So we know that Grant Thornton has been a great partner with the Chamber for a number of years, and we can depend on them to give us answers when we need it the most. So thank you so much for joining us. So today we'll have Laura McLaughlin, Kelly Kolke, and Jillian Murray of Grant Thornton. And I will turn things over to Laura to get us started.
All right. So thanks, Sherry. So first off, just good afternoon to everyone who is able to join us today. And we do have three presenters, of course. So we have Kelly Kolke, who is a tax specialist with the firm. We have Jillian Murray from our advisory practice, and myself representing the assurance practice. So today we will cover a variety of topics in relation to COVID-19. And some topics we'll be covering are around the wage subsidy and other financial measures put in place, financial statement impact, and cash flow management. We hope to provide each of you with some information to help you navigate through your way with your businesses in these unprecedented times. I will turn this over to Kelly to start speaking on some of the federal incentives, and give me 1 second while I get our slides up and running for everybody to do that.
Okay, and while she's doing that, I just want to remind everyone to make sure that your connection is muted so that as the presenters are talking, that we won't have any competing sounds in the background. A lot of us are working from home these days, and it could be kids or dogs or neighbors or other people making noise. So please do make sure that your line is muted. Okay, back to you, Laura.
Perfect. We'll let Kelly get started.
Okay, so one more slide there, Laura. And keep going. There we are. Okay, so I'm going to be talking today about the Canada Emergency Wage Subsidy, and I'll be referring to it as CEWS, so I don't have to keep saying the 4 words all the time. And so the CEWS has been put in place by the government in order to help support businesses and encourage businesses to be able to keep employees employed so that they don't have to go through the EI system or the Canada Emergency Response Benefit, the CERB system. The COVID-19 hit our country very quickly, and of course it was very hard to try to react to it from a government perspective to put things in place. So even though it's now about a month and a half ago that COVID started, it took a while for these programs to come out, and so there's been a lot of uncertainty within the business world as to do they apply to the CEWS? Should they be doing this? A lot of businesses had laid off employees very quickly because their businesses were shut down or other reasons, and wanted to be able to have their employees be able to access the EI system and the Canadian Emergency Response Benefit. And then after that happened, the CEWS started to get announced, and so there's been businesses that need to now look at this program and determine what is the better program for their employees to be with. So we're going to look at a number of aspects of the CEWS program from the employer perspective, looking at what is what businesses do qualify, and then what kind of a compensation could those businesses expect if they do qualify under the CEWS program. And so, as I said, this program is a wage subsidy. It can provide benefits to the company up to 75% of the first 58,700 of an employee's wage, so the company can benefit for a reimbursement of wages up to a maximum of $847 per week per employee. Right now, the program is running, scheduled to run from March 15th to June 6th. And we haven't heard any word if it's going to expand beyond that date at this point in time. And as I said, the program kept evolving as it got put out, and later on in the announcement of the program, not only will the companies be compensated for 75% of wages for qualified employees up to $847 a week, but they can also be compensated for 100% of the employer's contributions to CPP and EI relating to those employees who are being compensated. So this is a very positive aspect for employers, because essentially they can bring employees back, be compensated well with regards to the wages they are paying, but then also get compensated for the employer portion of the CPP and the EI as well. And we'll get you to move the slide there, Laura. So who qualifies for the CEWS? So the government has made this pretty far-reaching. They have allowed taxable corporations, individuals, partnerships with eligible employers, and certain nonprofit organizations and charities to be able to qualify for this subsidy. So when we compare it to the 10% wage subsidy that was firstly announced, that subsidy had some restrictions of who could qualify for that 10% subsidy. Fortunately, the CEWS does not have the same restrictions in place. So most businesses that operate and pay employees can qualify if they meet the requirements under the CEWS program. Some entities that do not qualify are public sector employers, things like municipalities, local governments, and crown corporations. Those entities will not be able to apply under the CEWS program. And I know our firm has been dealing with a number of clients who are, kind of quasi in that government space and trying to determine whether or not they qualify or not. And the legislation is pretty clear with regards to how the entities are achieving their nonprofit status under what section of the Income Tax Act. Definitely won't go into all that detail, but if anybody has any kind of questions from that aspect of things, can reach out to their advisors and kind of can see if they possibly can qualify. The last point on this slide is watch out for duplication of benefits, and there is specific amounts of the legislation that indicates if an entity is already receiving the 10% wage subsidy and then they apply for the CEWS, the benefit they're going to receive from the CEWS will be reduced from what they've previously received under the 10% wage subsidy. So when we're looking to see what businesses will qualify, the program has been put in place for businesses that have received a hardship in relation to COVID-19. And so they had to have a benchmark as to how do you determine whether a company or an entity has been affected by COVID-19. And so what they've decided to do was look at a comparison of a revenue decline. And initially, the revenue decline was a year-over-year decline. So looking at March of 2019 compared to March of 2020, April of 2019 to April of 2020, and May 2019 to May of 2020. And if the revenues dropped in the month of March by a 15% decrease, then and we'll go through the periods later on, but there's a period that would then qualify for the CEWS. And similarly, a 30% decrease in April and May. Now, interesting to note, when CEWS first came out, it was a 30% decrease that needed to happen in March. And then I think the government realized that COVID really hit about the middle of March. And so they've allowed for a 15% decrease in March to be able to qualify. One of the nice things about the CEWS legislation that's been put in place is they wanted to provide some certainty to employers. And so they put in there that if an entity qualifies for the Qs in 1 month, they automatically qualify for the following month as well. So, for example, if the entity qualified for in March for the revenue decline, they automatically qualify in April. Similarly, if they qualified in April, they automatically qualify in May. So it provides some certainty to business owners to be able to operate and make decisions as to what they're going to do with their employees. Also, when the Qs legislation first came out, there was some comments that it really didn't help startup businesses or businesses that were on a growth plane. And so if a business was seeing substantial growth from their 2019 revenues to their 2020 revenues, but then all of a sudden saw a decline, but the decline didn't allow them to enter the program because it wasn't a significant decrease compared to their 2019 revenues. They put in a measure that the entity can look at the average of their January and February 2020 revenues, then compare their reference period to that average for January and February of 2020. And if it saw a decline in the appropriate percentages, then it would qualify for the Q subsidy. Interesting to note that if the entity chooses to compare their reference revenues, so their March, April, or May revenues to the average of January and February, they have to stay with that approach through the whole program. They can't look at January, February for one period and then the next period say, okay, now I'm going to go back and start to compare it to the prior year. So if we just look at a quick example that we have here. So if we have an entity that for the month of January and February had revenues of $100,000 and then $140,000, the average revenues for the 2 months combined is $120,000. If their March revenues were $90,000, then that represents a 25% decrease, and then they would qualify for the month of March and automatically qualify for the month of April. Then when they look further to the month of May, their month of May revenues would have to be $84,000 or lower, a 30% decrease in comparison to the average of 120 in order to qualify for the month of May. So as I said, one of the interesting parts on the Qs is that we're comparing revenues on a monthly basis. So the month of March of 2019 compared to the month of March of 2020 and so forth for the other months. But when we're looking for what the claim period is, the claim period doesn't correspond with the monthly periods. So if an entity qualifies for the decrease in the month of March, then they can get compensated or provided the wage subsidy for the period of wages paid from March 15th through to April 11th. And those the dates are listed on that slide there, so I won't go through either date. So just important to note that the period of which you get compensated does not correspond to a monthly period, but it has a specific 4-week period of which the employer can be compensated. So what qualifies as revenues? And I can tell you that this had some conversation within our firm, and I'm sure many other firms, as when the legislation first came out. And so, was revenues going to be, how would it be calculated? Would it represent a cash flow? Is it done on an accrual basis? And so the legislation that has been put forth provides some flexibilities for the entities to be able to determine their revenues. They can either use their normal accounting accrual methods in order to calculate their revenues, or they can look at calculating the revenues on a cash basis. And so this can be a vastly different number depending on how a business operates. Once a business chooses whether it's going to calculate their revenues on an accrual basis or a cash basis, they are locked into that choice during the course of this program. Also, they want to take out anomalies inside the revenue stream. And so if there is extraordinary items or amounts of revenue that's based on capital dispositions, those amounts are excluded from the revenue calculations. They also want to take away games in relation to entities that are having transactions with the non-arm's length parties or related parties. And so when determining the revenues for the periods, it's determining the revenues from an arm's length source. So any revenues that are being received from a non-arm's length transaction, for example, selling widgets to a related company, paying rent to a related company, those revenues are excluded when we're looking at the revenue calculation. And lastly, on this slide here, there are many situations where entities operate as different, operations can be operated through either one entity. So we could have one entity with operations in various places in the country. That entity there is restricted to just looking at its revenues, and we can't. There's nothing in the legislation to break it down by area to determine whether or not there's been a decline. So it has to look at the entity as a whole. But if you have groups of companies, so we got company A, company B, company C, and those companies are all affiliated, and essentially affiliated means that those companies are controlled by the same person or the same person and their spouse. Inside an affiliated group, you can choose to report the revenues on an individual basis or a consolidated basis. And so I have a client that is an affiliated group, and they looked at it, and they have payroll in both places. One company appeared not to qualify for the Qs, so they wouldn't get the benefit of the Qs in one company. The other company clearly qualified for the Qs. So they're going to make a decision to elect to operate under the consolidated basis. Their overall consolidated revenues will have dropped enough to qualify for the Qs, so now all of their payroll will qualify for the Qs. So when we look at what kind of employee qualifies, so basically employees include any individual who is employed in Canada, and they have to have been employed throughout the eligibility period and can't be without pay for any 14 consecutive days within that period. So when, for example, when we're looking at the March 15th to April 11th period, they couldn't have been without pay through any 14 consecutive days within that period. If they were, their wages would not qualify under the Qs program. As I said, I had many clients that decided to lay their employees off for various reasons on right around March 18th, when this was all starting to get announced. And then the Qs legislation came official around March 10th or April 10th. And so I had a number of discussions with the clients as to, okay, now because we're entering into a new period, April 12th to May 9th, what do we want to do? Do we want to bring your employees and put them into the Qs program or keep them on the CERB? And important to note that the CERB, the benefit that the employee can get under the CERB is $2,000. Under the Qs program, the benefit is $847 a week, which turns out to about $3,400. And so when you work through the math and situations, a lot of times it'd be better off for the employees to come back to work, even though they may not be, they may be staying home, but receiving a wage. They could get a higher take-home amount, and the employers can get compensated. We'll go to the next. There we go. Okay. So what kind of wages get involved with regards to getting subsidies for the Qs? So it includes the regular remuneration, salaries, and wages that you would pay, and it also includes other taxable benefits. And you may ask, well, what would be other taxable benefits? Things like vehicle allowances can be in there, but essentially any taxable benefit that is included on a T4 for the employee, those amounts can get included and can get compensated through this program. What it doesn't, what it excludes are things like severances, stock options, and we have their personal use of auto and similar. So if a vehicle is being provided to an employee and they have a standby charge and an operating benefit in relation to that personal use of that vehicle, that will be excluded from the calculation for the Qs. So how do we go about calculating the benefit for the Qs program? Essentially, we need to look at, first of all, pre-crisis wages for the employee. And so for the amount, the maximum amount that can be received under the benefit of the Qs is 75% of the remuneration to a maximum of $847 a week, and the remuneration paid up to a maximum of $847 per week, or 75% of the employee's pre-crisis weekly remuneration. So I talked to a client yesterday that actually used the calculator and went through the program, and they needed to, first of all, go through all their employees and calculate out the average pre-crisis weekly remuneration from January 1 through to March 15th to get a baseline number. And then once they have that amount, then they can determine what is actually paid to those employees, and then determine how much is going to be compensated under the Qs program. So, for example, if you had an employee who was operating for you and they were receiving a wage, let's say they're receiving $60,000 wage prior to the pre-crisis. When you work through the calculations, as long as you were paying them $847 per week, you would be compensated up to the maximum amount for that weekly program. If their pre-crisis wages were below that, we're at a lower value, let's say $30,000 a year annually, and you work that out to what the pre-crisis weekly average is, then you'd be restricted to 75% of the pre-crisis average amount that for that employee. They also, when they brought in the legislation, they wanted to stop employers from playing games in relation to related employees. So what do I mean by that? Well, there's many business owners out there who have made a decision not to take a salary from a corporation and have decided to be compensated through exclusively dividends. And so they put provisions in here that if you are a non-arm's length employee, so you're related to the company, and you do not have any pre-crisis average wages, then you will not qualify for any Qs reimbursement. And so we can't just simply take an owner manager who had not received wages in the past, put them on payroll, and get a benefit of that. The calculation will be determined that the benefit would be zero in that situation. Okay, Laura. So, as I mentioned previously, under the Qs program, the employer is also being compensated for 100% of the employee's CPP and EI for any employee that is on leave in relation to the COVID-19. For this one here, there is no refund max. It's not tied to a 75% computation, and so the employer will be fully compensated for the CPP and the EI on the employer portion. One of the things that is we're finding kind of a little bit difficult for the businesses under this program is it's being administered through CRA's My Business account, and so many entities do not have access to the My Business account at this point in time. Many businesses have access to represent a client, but they do not have access to the My Business account portal. And so it can take an 8 to 10 day process to get access, and so that should be started immediately if somebody is willing to put in an application through this program. And the government has been very strong in their wording that employers must kind of act legitimately to qualify for this program, and if they try to access the money fraudulently, there will be penalties for the abuse. There will be and the penalties are quite strong. And then lastly, the CEWS subsidy is taxable, so it is a consideration that that it will be a taxable amount. But at the same time, the entities have the offsetting salary deduction, and so if somebody is deciding to bring back employees to get them on the CEWS, to help them out, to keep them employed, they will get a subsidy and that is taxable, but they also have the deduction at the same time, so they're no worse off in that situation. And go to the last slide there, Laura, thank you. And so again, the way to apply is through the My Business Account portal. It opens up on April 27th of 2020. And also, if you do not have direct deposit lined up with CRA, get that lined up as well, so it can get an easy access into the entity's bank account. And that's my summary of the CEWS. Laura,
All
I
right.
think you're going to take over, yes.
Thank you. So I'm just going to highlight a few more of the federal measures that are out there as we go through to start with. So the first one is in regards to the HST. So if you are in a position where you're looking to have an HST refund, then you should be looking to get your HST filed as quickly and on time as you can, so that will allow you to have some cash flows coming in. And if you are in a position where you owe HST to the government, then you should be looking to for the opportunity where they are allowing you to defer any payments until June. So it's not that you don't have to pay it, but you have a deferral that you don't have to come up with money between now and June. So it's June they'll be coming right now to look for those payments. So just again to help with some cash flow. The next one are a couple other measures. So the WCB, so in Nova Scotia, basically similar to what the HST guidelines are. The WCB has allowed remittances to be held off from being paid until July 2020. So again, to allow you to keep that cash flow in your business at this point in time, and they'll be looking for the payment on that in July. There are also some renewal fees that the federal government has waived depending on different programs and businesses that you're in, so that if you have a specific business that may be applicable for that, then that's something else that you may want to look into. And then, of course, there are the tax deferral for income tax payments that the government has allowed. So this is for any income tax payments that were due or installments that were due after March 18th. Those are now deferred until September 1st. So that includes your corporate, as well as, I'm sure most of you are aware, but personal filing extensions have been, personal tax filing extensions until the end of May, and the taxes owing are also deferred to the 1st of September for personal taxes. So in line with the corporate as well. The next one, the Canada Emergency Commercial Resident Rent Assistance. So this program was announced. There's not a lot of details out on how it will be managed. However, it has just been announced that it's intent to introduce this program for small businesses out there. So the program will seek to provide loans, including forgivable loans to commercial property owners, who in turn will lower or forego rent to the small business that they are leasing to. So that's for the months of April, May, and June, and what they're saying is it is retroactive for April at this point. The implementation of the program will require a partnership between the federal government and provincial and territorial governments, which are responsible for the property owner and tenant relationships. So the details of that has not yet been released, but stay tuned, and hopefully in the next week or so there will be something out there on that, based on the timelines that we've been seeing so far, and it was just announced there a week ago. The next one, which Kelly touched on briefly, but is the 10% employer subsidy. So this was one of the first measures that was initially announced, which people started looking at before the CEWS was out. So this is the 10% temporary wage subsidy for qualifying employers who may not qualify for the CEWS. So that would be if you don't meet the 15% revenue test or the 30% in the subsequent months. This amount is still available. And as Kelly mentioned, if you did apply for this in the first period and then you subsequently do qualify for the CEWS, it will be taking off your calculation for the CEWS amount so that there isn't double dipping into the programs. This one you can apply for immediate benefit, so not through the same process as Kelly mentioned through the business account, but rather you can receive this funds or keep these funds through the reduction of your payroll deductions which you remit to CRA. So who qualifies? So qualifying employers who may not qualify for the CEWS, of course, based on the test. Then individuals excluding trusts, partnerships of qualifying employees, not-for-profit organizations and registered charities, as well as CCPCs eligible for the small business deduction. So that would be for organizations that would have taxable capital less than $15 million. Then this, how do you compute this benefit? So this benefit is definitely a simpler calculation than the CEWS. It is basically the greater of 10% of compensation paid from March 18th to 2020 to June 19th. The maximum you are allowed to collect on a person is $1,375 per employee and $25,000 in total for the employer. And you don't have to share the maximum subsidy around groups. So if you do have a group of entities, each entity will be available to receive this. And then the receipt of the subsidy, of course, is through your continued regular payroll deductions. So you calculate your payroll deductions for CPP, EI, and income tax, and then you withhold your 10% off of the amount you actually remit to CRA at that time. And the first period for that was March 18th, so that's when you could start any periods on or after that date. And as I mentioned, they reduce the CEWS. And if the business is closed, there is no subsidy because it is based on actual remuneration paid. That is one of the outlines there, is that you have to pay the remuneration to your employees. And again, the benefit received is taxable to the employer. So the next federal programs we have, the next one is the CERB, the Canadian Emergency Response Benefit, and a few others I'll talk about as well. But the CERB, I'm sure a lot of people have been hearing lots about this, but right now, most up-to-date information we have on it, and it has changed a week or so ago there, but to allow for more application for it, more broader application, for those people that were falling through the cracks if they were working still a little bit, so that they did have a little bit of income and weren't eligible for the CERB. But to qualify, you must have employment income, including employment income, maternity or parental leave benefits for 2019 of $5,000 or in the preceding 12-month period, the day the application is processed. 14 days of consecutive work stoppages requirement, and it does pay the $2,000 per month for the next 4 months. So now what they've opened up is you are also, instead of having no wages, it is okay if you earn up to $1,000 per month in wages as well as receiving the $2,000. And don't apply for the CERB if you've already applied for EI. So if you apply for the CERB, you'll receive that, and it'll be put into that bucket at this point in time, and don't turn around and apply for EI because that may cause some confusion in the system. And alternatively, if you applied for EI before the CERB was really out there and available, a lot of the individuals have been put into the CERB instead of receiving the EI. And seasonal workers are now eligible under this program as well. Then there's the work sharing program, which I haven't seen a lot of, but I heard of a few people talking of it and determining whether that may work for their business. So to help some employers avoid layoffs, it's basically a temporary reduction in the level of business activity that the employer is experiencing, and it's beyond their control. So this allows basically an agreement to be in place between employers, employee, and Service Canada, so it must be registered, to allow basically work sharing of time in the entity or the organization. So it's a period of at least 6 consecutive weeks, and it can be up to 38, and that has been extended to 76 weeks. Then we have the Supplementary Unemployment Benefit Plan. So this is not a new program, but it may be something that people decide they want to use. It allows an employer to top up an employee's EI benefits during a period of unemployment due to temporary stoppage of work or injury or quarantine. Must be approved by Service Canada. And again, it's not new, but it may be used more heavily during the COVID downturn of business. So this would be if the business has stopped work, you're not able to pay your employee, and you may not qualify under the Qs, then this may be something that you would look at. So if your person is off and collecting EI versus the CERB for certain reasons, then they might look at and say, okay, well, I know my person's receiving EI, but I would like to be able to give them a little bit something of a top up. So with these, really, it's important for the employers to determine what makes more sense for their business and compare the couple of programs that are out there. Canada Student Jobs Program. So this one's for students, obviously. Employers can get up to 100% subsidy to cover costs of hiring students. Previously, this was only charities and not-for-profits. We are not clear, there's not a lot of detail out on this one as to how you apply for it, but there has been extension of time frame extended for the job placements up until February 28, 2021, and part-time work is now eligible. So we expect there will be more information released on this in the coming days as well. And the new one that was released also for students, so the Canada Student Emergency Benefit. So this is if you're a student, you're able to receive now $12.50 from May to August 2020. If you are unable to get a job, there's an increase there if you are a caregiver or have a disability as well. And the qualifications are if you're in post-secondary now, you graduated high school after December 31st, 2019, and you're entering school in the fall. The period starts from May 2020, and similar to the CERB, you're allowed to earn up to $1,000 per month and still receive this benefit of $12.50. So that is definitely something to keep in mind for anybody who has students or is involved with students as well. And that will be paid via CRA too. So those are some of the recaps of some of the other initiatives that are out there, kind of the detail that's available right now. And I know there has been some more released for other industry specific over this week. And again, more information and details will follow on those in the coming days as to how some of those will be rolled out and available. Next topic, just kind of switching gears a little bit here from the measures, but some things to think about from the financial statement impact side of things. So aside from the cash flow, there's also a financial statement impact that you may be thinking about or dealing with kind of as you may be trying to get bank financing or just get through your regular year ends and that sort of thing. So the COVID-19 does present additional considerations to be addressed in and around your financial statements and your internal financial reporting as well. So from the assurance side of things, when we're providing review engagements and audits to our clients, there's a couple of things that we do need to keep in mind that have kind of shifted gears from our end, where we have to have more focus and more rigor on our side as we go through. So we have to revisit the going concern assessment, so the impact on that COVID-19 has had on the businesses overall. So when we're doing our work, we are thinking about that, as well as getting an understanding. So it could be that, yes, your business is still a going concern. We've put these mitigating factors in place. You know, maybe we're not going to meet our targets for next year, but we still are able to find our way through based on the processes and controls and taking advantage of the programs that are out there. So we just basically need to do some work around that and understanding that with our clients. And then we identify any subsequent events too. So lots of people have December year ends. Obviously, COVID did not happen in December. We weren't prepared for it on December 31st. Your financial statements will not reflect any impact at that point in time. However, your statements may not have been finalized and signed off before COVID hit. And if that is the case, then we are required, and management's required, to assess any impact based on the best knowledge available to you as of the date of the sign off on your financial statements and how that may impact. So that is often going to require a note disclosure in your financial statements. And as we move along into different year ends later in the year, it could actually result in adjustments on your statements themselves. Of course, along with that, there could be a potential of asset impairment. If, depending on whether we determine there's any permanent impairments in place as a result, and collectability of accounts receivable. So of course, from our perspective, but more from your perspective, how important it is for you to monitor your accounts receivable, to be on top of them, watch for and follow up on the collectability of any receivables that you have out there, so that you can try and manage your way through the cash, through the tight cash flow that you may be experiencing. Revisions to accounting estimates could also be something that you look at. And then a couple other ones. So kind of from our perspective as well as your perspective, segregation of duties is something that could be impacted with people who are working from home, working different locations, not able to have the internal controls or the process that you might have normally had in a business. You could have one person doing everything where normally you do have it segregated by a couple of people. So there just are things to think about when you are doing things differently, and to ensure that you are protecting your business as much as you possibly can still with these. Of course, with lack of segregation of duties allows more opportunity for potential fraud. So that's something business owners should keep on top of their mind as well, is to ensure that they are staying on top of what they can, and know that they are ensuring that any processes around the financial side of things is monitored and overseen as close as possible. And then also on your debt and your borrowing base and covenants. So if you have debt with banks, borrowing bases on operating lines, how do your receivables inventory tie into those, and what could be the impact on your covenants up and coming. So, and Jillian will get into some of the discussions around conversations you should be having with your banks, but it will be important to have those conversations in a go forward manner, more so than ever. And additional risks around the financial statements themselves. So as a whole, we just basically want to make sure that we're sitting back and thinking about what new risks has COVID presented. Revenue recognition could be one. For example, we usually always go to the store and we buy our product and we pay for it at the cash register. Well, now we might be ordering it online for many businesses who have tried to transition to that. And so what does that do for revenue recognition? When does the product get recognized? If I order it online today, but it's not delivered until next Thursday, what is the proper revenue recognition? So cash is, the companies are happy to receive the cash up front, which is great for cash flow, but that may not match your revenue recognition policies, and it may not match what you have had prior to COVID-19. And then the last piece is just the use of technology. So we're all using technology in a different way and at home. So just things to think about again around your finances, around any company information you may have, but the security around it, the reliability of the technology that you're using, and the confidentiality of it. So again, I know one of the things that is circulating is about the potential for hackers to kind of, look for the opportunities when people are vulnerable, which is obviously COVID-19, the state we're in. So just be sure that you are being mindful of the security around your technology that you're using and how you're using it in your businesses. So those are the kind of highlights that I had on your financial statement and your financial process impact. And now I will turn it over to Jill to take on the next sections.
Great, thanks, Laura. Hi, everyone. So I'm going to quickly talk today about a lot of the credit programs that have been put in place as a result of the COVID-19 developments that we're under. And I will also touch briefly on the importance of cash flow forecasting, and particularly as it relates to preparing to talk to your bank about some of these programs. So the one you're probably hearing a lot about is the Business Credit Availability Program, or BCAP as we've been calling it for short. So this is effectively the overall federal umbrella program that's been put in place, that it's the funds that the government has made available to support Canadian businesses during COVID. So they're going to be made available through a combination of the Business Development Bank of Canada, the BDC, and Export Development Canada, as well as partnerships with all the major chartered banks and credit unions. So the two financing programs that are available through BCAP are first the Canadian Emergency Business Account, and second the Small and Medium Enterprise Loan and Guarantee Program. So I will walk through those in a bit more detail shortly. I think a key thing to remember is that these programs that have been put in place are temporary in nature. They do vary in length, but they are temporary, and they really are intended to help businesses through the crunch that COVID is causing. I think it's also worth noting that although the BCAP programs have been put in place, they really are in addition to the existing programs that you would already have with your BDC, EDC, as well as your chartered banks. So in many cases, a lot of these institutions are also providing additional flexibility in your existing lending programs, sometimes in the form of principal holidays or flexibility with your operating line balances. So from a timing perspective, some of these programs are up and running and others we're still waiting on. As Laura and Kelly indicated, things are changing daily. So in every single case, I would recommend reaching out to your relationship manager, whether you're already a client of the BDC or your charter bank or credit union, and really understand what the programming looks like and what the starting point is for what may look best for you. So the first one I'm going to talk about is the Canada Emergency Business Account. So this one, this one is up and running, and I would, based on discussions with some of the banks and clients, I would say this is probably the quickest source of cash right now. It's being offered through your financial institutions, and the criteria are that you have to have payroll, 2019 payroll based on your T4 summary, between $20,000 and $1.5 million. So initially when this came out, it was between $50,000 and $1 million. So they did last week expand the criteria so that they could capture more businesses. So the maximum amount of the loan is $40,000, and it is a revolving loan, meaning you don't have to draw down the entire $40,000. And it is 1/4 of the balance is eligible for forgiveness. So if I think about most of these programs, this is really the only credit program that at this point has any real consideration for forgivable amounts. So what happens is if you draw down $20,000 between now and the end of December 2020, the remaining, and if you don't repay it, the remaining amount turns into a term loan that you do have to repay over time, over the following 3 years. So it is interest-free. It is interest-free. There's no interest paid until after the balance that's due after December 31st, 2022. So if you do repay 75% of the balance on or before December 31st, 2022, that is when the remaining 25% of the balance is forgiven. So this is available now, and it's been up and running for a bit now, and the funding comes through your existing financial institution. So, we recommend you should be able to access it online through your online banking portal, and it is pretty quick dollars to get in your bank account. We move to the next slide. We'll talk a little bit. I did put in some of the eligibility criteria for this program. So you need to have an operating company registered in Canada on or before March 1st, 2020. You need a CRA business number. You do have to have an active business or checking account with your primary financial institution. You should not be delinquent on your existing borrowing facilities, and we did already talk about the payroll the payroll criteria. And essentially, these funds are designed to help you with non-deferrable operating expenses. So things like payroll, your rent, your utilities, all those somewhat fixed costs that your business is going to continue to incur regardless of whether you're open or closed. You can't use the funds for prepayment or refinancing of existing debt or paying dividends to shareholders or increasing management compensation. So if you're looking for new capital, this is probably one of the easiest ways at this point to access that. So the next program I'm going to talk about is through the Business Development Bank of Canada, the BDC. So this is their working capital loan program. And this is sort of more of a medium-term solution. It's based on our understanding that the amounts can be between $100,000 up to $2 million. And the amount of the loan would be really determined individually by the client working with the BDC and based on your projected need for cash. It's an operating line, so the BDC is going to want to work with you and your existing lender to understand what operating line you already have with your existing lender and how this is going to fit in there. It's a flexible structure. We understand it's going to be a 3-year term, 36 months, with interest only for the first 12 months. And then over the remaining 24 months, you would repay 40% of the balance. And then finally, there would be a balloon payment of the final 60% at the end. And from a pricing perspective, we understand that it's going to be priced at the BDC floating rate, and they are going to take a general security agreement, but recognizing that for a lot of you, you may have existing operating lines that they're understanding that they may have to be in second position behind the existing lender. And this is underwritten and funded directly by the BDC. And this program is open, so we would recommend talking with your bank and with the BDC to see what's available there for you. The next program is the co-lending program, which is a longer-term solution, and this is also with the BDC, in the form of new term loans that can go anywhere up to $6.25 million for small and medium-sized companies. So this is effectively bringing the BDC together with financial institutions to co-lend, where the total value of the loan would be advanced at 80% by the BDC and 20% by the bank or your credit union. So there's 3 segments in terms of the dollar value of these loans. So for businesses with revenue less than $1 million, we understand that loans can be available up to about $300,000. For businesses with sales between $1 million and $50 million, you can have access to potentially up to $3.1 million. And for businesses with revenues in excess of $50 million, you could get all the way up to the 6.25. As I said, this is a longer term solution. So it's a 10-year term with interest only for the first 12 months. And from a pricing perspective, I think the banks are going to be doing most of the underwriting of these products. So what this means is that the banks the financial institutions will complete all the underlying analysis on the company and determine what level of loan would be advanced. And they would share that with the BDC funding 80% and the bank funding 20%. So this program, I have not heard yet today, but I do not believe it is open as of yet. So we are, all of this is just based on information that we have so far. So again, I would highly recommend you talking to your bank or the BDC about this program once it does become available. So the next set of programs is through the Export Development Corporation. And so EDC, you may say, well, EDC, if I'm not exporting, why would this be relevant to me? One of the key things that's happened with COVID is that EDC has actually opened up their guarantee programs to businesses that are not exporting, so domestic, opening up their programs to domestic sales. One thing is very important to understand about EDC is they're not actually lending you the money, they're guaranteeing you. They're providing a guarantee for you to get an underlying loan from your financial institution. So that's an important distinction. So the EDC's product, Laura, if you want to move to the next slide. It is, as I said, it's a guarantee program. and it's through their enhanced loan guarantee program. So they're now in a position to guarantee up to 80% of a new operating credit or cash flow term loan that would be placed by your existing bank. And the maximum amount of that loan is $6.25 million. And again, the amount of that underlying loan, you would work with your bank to determine what that should be. Once again, your bank is lending you the money, EDC is providing you the guarantee. And this is a shorter term product. The guarantee is really available for 12 months, and it does come with a fee. So you would take your underlying loan with your bank, which would have its regular pricing and interest rate structure. Then you would have a fixed guarantee fee paid to the EDC of approximately 1.8%, we understand, on the loan amount. And at this point, I believe they are offering a deferral, a 6-month deferral on that EDC guarantee fee. And once again, the intention of this is to be used for operating expenses and not dividend payouts and shareholder loans and refinancing of existing debt. And another one that's relevant again is Farm Credit Corporation. They have put out a $500,000 revolving operating line for 24 months. And this one I just bring to your attention. It is an interesting one to think about if you are anywhere in the agricultural space or even food, in the food production processing space. I would encourage you, I won't dwell too long on it, but do go to the Farm Credit Corporation website and see the types of businesses that could qualify for this. It's just another new option. And so earlier, I guess later last week, there was a few other programs that were announced, including support for rural businesses through the Community Futures Network, $675 million to support small to medium-sized businesses that have not been able to access other COVID supports through the, and this will be offered through their regional development agencies. So really, I think there was a message that some of the really small businesses were being missed. So I think the Prime Minister's aimed to do this through getting at rural businesses and small businesses. There's also some other programs around innovation and for young entrepreneurs. And then finally, he did also announce on the next slide, programming and support for small and medium Indigenous businesses. And those are going to be offered through the Aboriginal financial institutions. So at this point, all of the program that that last slide, it's stay tuned at this point. There's no information quite yet, but I just wanted to highlight those. And overall, just one thing I just want to continue to reiterate, these programs are temporary. They're designed to help you if you've been impacted by COVID. But the banks they are still new debt. As I mentioned, there's not a lot of free money here. So you have to really keep in mind what is going to be your plan for repayment, because you will have to repay this. So don't go into this with the thought process that you're getting money that's not going to have to be repaid. And recognizing it is 1 o'clock. Oh, sorry, there are 2 quick provincial programs. One is the Small Impact Grant. This is for Nova Scotia. And this gets you a one-time grant of 15% of revenues, either from April 2019 or based on February 2020. And you can apply online for that, and that deadline is closing very shortly on April 25th. And the second one is just a bridge funding available for employees on the next slide in order to bridge them from the CERB program, and it's a $1,000 payment. And finally, very, very quickly, I just want to touch briefly on cash flow management. Now more than ever, it's critical to manage your cash flow and understand what's going on with the cash that you have in the bank or your operating line balance, and really what your plan is going to be to get through COVID. We've been working with our clients to build anywhere from 12 to 36 week cash flow projections, and they're based on the cash that's coming in the door and the cash that has to go out the door, not an income statement, just really what's coming and what's going and how can I project that. And I think it's really critically important for you to do that now. It'll help you understand where your bank balances stand to allow you to make real-time business decisions. So when you're thinking about which wage subsidy program applies, do I need to apply for any of these loans under or relief programs under BCAP? Doing these cash flows will help you show the need for cash and how you're going to, what levers you can push and pull to alleviate expenses. The second thing that's important about doing it is that it really benefits, it demonstrates to your bank and your stakeholders that you've taken the time to think about the impact of COVID and how you're going to work your way through it. It just shows that you'll have a deeper understanding of your cash flow requirements in the short or near term, so that you're not going into the bank and saying, oh, I need $1 million. And your banker looks at you and says, well, you know, what do you need it for? What are you going to use it for? If you've done your cash flows properly, you'll be able to articulate that to them. And I think you'll have better success when you're working with your banking partners. And it'll help you also look out into the longer term and really say, you know, we can't predict when we're going to come out of this, but here's some strategies, here's some best case, worst case scenarios of what that might look like. So I think I'll probably leave it there just because it is 5 after 1, and you know, we will make this information available. Towards the end of the presentation, I do have some tips in terms of preparing yourself to talk to your banker, but we can make the presentation available through the chamber, and you guys can have a look at that. But I think suffice to say, preparing those cash flows will really arm you well for going in and having that discussion.
That's wonderful. And the information, I know I've taken a lot away from it. I know our office is getting a lot of questions from people trying to, you know, wade through and wondering what can they apply for, what programs are in place. They're all in different situations, from whether they're not-for-profit or a sole proprietor or a larger business, and just trying to figure out which programs apply to which business. I think this was very helpful in that. We do have a few questions. If we can take just a few more minutes and answer the ones that were submitted to us on our chat, is that okay? You can stay a few more minutes?
Yes.
Okay, thank you, Kelly. So there were a couple of questions in particular on the SEBA. So one of them is, if you need to buy new equipment because the current equipment broke or malfunctioned, can you use that fund to purchase something that will keep you going in business?
Yeah, so it doesn't specifically exclude capital expenditures. And, you know, I would say, first of all, definitely check with your bank. But, you know, if you've got existing equipment that has broke and you need it to continue to operate your business, I would say, in my view, that would be an acceptable expenditure.
Okay, and I know that they say with SEBA that you aren't to use those funds to pay down current debt that the business has, but if you needed to purchase stock and you're purchasing that stock with a credit card, can you use those funds to pay the credit card?
I mean, I would say yes, because, you know, whether you're paying for the money out of, whether you're paying for your stock with a credit card or with a, you know, with your cash in your bank, it is still an operating expense of the company. I think what they're trying to alleviate is you getting the money and paying down, you know, a bigger chunk of existing debt. I think it's really meant to be geared towards keeping you operational and during this time.
Okay, and maybe can I get you to flip back to slide number 12? There was a question about remuneration. So on that slide, they're wondering, thank you, Laura. Okay, so, you know, does that apply only to, you know, employees, or does a contractor working there also qualify?
I'll take this one on. So a contractor would be a self-employed individual. So to the company, they are not an employee. If somebody's working for an entity, it could be a company, it could be an individual, as a self-employed person, then whatever that entity pays to that self-employed person would not qualify for the Qs because it's not wages. Conversely, the contractor themselves, they have the opportunity, if they're incorporated, to pay themselves a wage. And if their revenues drop by 30% or 15% in the month of March, then they could look to making their own application to the CEWS program.
Wonderful. Okay, thank you for the clarity around that. And on slide 25, you had some criteria about the, I want to say the Canada Emergency Response Benefit. So question being that with it stating that you have to have the 14 days consecutive without income, and yet now you're able to earn $1,000 per month, I guess, does there still have to be that 14 consecutive days without income that you're only earning it 2 weeks of the month, or how does that work?
Get off mute here. So as far as I understand it, you are now allowed to have worked up to the $1,000 as still as you're not over the $1,000, then you would be eligible for it. Yeah.
So it's not like they can only like work 14 days of the month and the other 14 have no money. It's spread over the month.
Correct. Yeah, the $1,000 is per month. Yep.
Okay, so I'm not seeing any other questions in the chat. So if anyone has one, oh, okay. I see one just popped in. With the wage subsidy program, do we have to calculate our revenue numbers based on March 15th to April 11th? That's certainly something I've been watching very closely, is the periods are not always month to month. Some of them have different stipulations. So could you speak to that?
The revenue calculations are on a monthly basis. And so when we're looking at the month of March, we're looking at the actual March 1 to March 31. And then those revenues can be compared to March 1 and March 31 of last year. And so if the month of March qualifies, then it's the payroll between March 15th and April 11th that will get access to the CEWS. And then it works similarly for the next months. So the access to the CEWS, or the wages that get access to the CEWS, that period doesn't match the revenue period. Hopefully I said that clear enough.
I think you did, Kelly. Great, thank you so much. So I just put out a last call for questions, and I'm just going to wait a couple seconds here and see if someone pops in.
I'm going to just one more thing, Sherry. So after I finished talking, I had one of your participants respond to me through a text to indicate that they were able to call the 1-800 number to Revenue Canada yesterday, get on and get access to the My Business portal directly there, and not have to wait the 10 days to get the password sent in the mail. So it's worth a try. It is a little bit difficult to get on that 1-800 number right now, but if you can get on, it might work.
That's fantastic. I know with our own situation where we have an owner listed from ages gone by, that we face some challenges in trying to navigate that. So I would absolutely suggest everyone go on and give it a try and see what you have set up now, because we don't want to see anyone waiting to try and navigate with CRA right now, because they're very busy. So do try to get on that account so that when that portal's open, you'll have an easier path to follow. So any closing comments from our speakers? Okay, so the one last question popping in. If my business did not close, but did lay off one employee for 15 days and then brought them back, could they look at the wage subsidy program?
So there was a 15-day period of which they were not working for the business, and so one of the requirements is that they could not be unpaid for a 14-day period within that reference period, with that payroll period, and so then that employee would not qualify for the CEWS.
So not for that month, but they would for the following month?
That is correct. Okay.
Wonderful. All right, so closing comments from anyone with Grant Thornton?
Right. Thank everybody for participating and listening, and hopefully that provided some clarity for some people that were joining us today.
Well, I know the Chamber is grateful for the support that we receive from Grant Thornton and many of our other members who've reached out offering to provide some type of information to our group. We know that it's vital that business gets information as soon as they can with these programs, and assistance in trying to navigate through, you know, it's a web of different things that are out there for them, but having a good understanding of how to access them is so vitally important. So as we mentioned, this is our first Bring Your Own Lunch webinar. We will be doing another one next week on Thursday. The theme is mental health, and we have a panel of 4 of our members who will be talking about some mental health resources and ways to cope with our added stress during this time. And I encourage everyone to join us again for lunch next week. And thank you all for having lunch with us today.
Thank you.
Thank you. Have a good day.